Now that we have a linked model for 2017, we're going to basically extend this data to 2018, 19, 20, and 21. So the simplest way we have done this so far is we've just extended, copied and pasted the data on each of the sheets. That's okay if it doesn't match at this point of time, because we'll start with the balance sheet, copy, paste, 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 and paste. The data will obviously not match because some of the data is not yet available correctly. P&L is going to be copied here, and then we're going to put this on the right side, so we can do a pasting of the P&L as well. Assumptions are going to get copied right from the top end, and let's actually do a copy paste of this set first, and this needs to be 74% only. We'll check what happens there. Copy from this all the way down till here and paste. Right now, what that does is we are assuming a bigger capacity here. What I would suggest is let's just take this set of data separately, and let's take rest of the data separately. Right, so I'm going to put in, maybe once they are done with this, then they're probably not going to add too much capex after that. Right, so they should be adding less capex. Utilization rate should probably go up a little bit by, let's say, 2% every year, or I can do that here itself by, let's say, 1% every year and increase that as it goes along. Maybe 1%, maybe 2%. We'll debate those numbers as we go along. What that would do is lead us to an increase in the production, and rest everything I can just copy and paste at the bottom. I'm going to select everything. We'll debate the numbers as we go along, so don't worry too much about that segment. And we're going to paste, 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 right? Once that gets done, you'll see the P&L gets populated. Capex and debt schedule needs to be worked around with as well. So we're going to select this data till the new debt raised column, and we're going to plug this in as we go along. So far we have assumed that this capacity expansion is going to come here, and that's going to increase the debt that is taken by the company in some of the years. Somewhere here, that's going to go up significantly, and obviously is going to increase the data points. Let's take the set of data here and just drag and drop it till here. Second year is a cash negative scenario that can't happen, so the firm will have to take more debt, but let's just see if the balance sheet balances. So our first task is to see if the balance sheet balances. So all the linkages are correct. So it does balance. So technically all the linkages are correct. We obviously need to work a little bit with respect to this acquisition. So now what we're going to do is, let's assume that this acquisition of 21 million tons is not there. Right? If this acquisition of 21 million tons is not there, that's going to be the capacity of the company approximately, and we've assumed some small capacity expansion. I think there's another 2 or 3 million tons that is on the card somewhere here, and then we can keep the capacity constant post that. Right, 21 odd million tons that is going to come is probably going to take this up to 94 million tons. At this point of time, we are, let's say, assuming without the capex what is happening, without the acquisition what is happening with the company. We look at the numbers, we look at the profit and loss statements, we look at the operating profits. They are kind of going down a little bit. We're going to incorporate the capex number at a later point of time with respect to the new acquisition. We'll see what changes that does to the balance sheet, because obviously that's not going to be a one-sided affair that only the capacity or tangible assets go up. They are buying this company in order to take the debt of Ultratech, of JP Associates as well, or JP Cement on the books as well, right? I'm also going to format this a little bit. So we're just going to put in all borders and then maybe put an outer thick border, right? That's what we have for the balance sheet at this point of time. That's what we have for the P&L. That's what we have for the cash flow. If we are ignoring that set of data happening, there is no other cash flow that is cash outflow that is happening. So the company keeps adding cash to the overall scenario, right? We can also just underneath it build the FCFF calculations. Now, why FCFF here is because we are going to basically work with a company that has debt, so, and is a little bit capital intensive. So we're going to work with Ebit into 1 minus T, whatever the tax rate is, add depreciation, and then 2 or 3 of these items are the same. We just plug those in. The debt calculations don't come into the picture every year, right? Now, what is the EBIT? EBIT is profit before tax plus interest, right? So that's what I'm going to put in here. That's equal to, for FY17, what's my profit before tax? That's this number. That's FY17, profit before tax, plus the interest component, close bracket, right? We didn't open a bracket, so we need to open a bracket as well. That's this, into 1 minus the tax rate assumed. The tax rate assumed is on the effective tax rate here. So we're going to go down and select this 30% and close bracket, and that's EBIT into 1 minus tax. Add depreciation. That's the next set of 4 items can come directly from here. I can just link it, select all this, format this, and just drag rest of the data points. And that's my FCFF. So that's equal to this plus the depreciation minus change in current assets plus change in current liabilities minus capex. That's my free cash flow to the firm that we are getting. We will quickly build in the rest of the model framework as well. So we do need to find the present value of this FCFF, which we will build in as we go along. For that, we will need the risk-free rate, we will need beta, we will need equity risk premium, which gives us the cost of equity. We will need cost of debt that we have assumed. We will need weight of equity and weight of debt, for which we will need market value of equity and market value of debt. Those are the data points which we are going to need. And then we will get the weights, which will eventually give us weighted average cost of capital, right? And we will need a terminal growth rate as well, which then will give us the final value of data, right? So we will need to plug in these data points as we go along, and we'll calculate some of those. Some of those are known. So risk-free rate should be 5%. Equity risk premium should be about 8% or so, approximately. Whatever the beta calculations is, we have to do this calculation as yet. But let's assume beta is 0.8 or 0.9 or whatever. That should give us cost of equity as 5 plus 0.8 into 8%. That should give us the data here, and percentage 11.4%. Cost of debt we have assumed on the capex and debt schedule. We already have this data, right? So cost of debt is 8%. That's available. Can I calculate market value of equity and market value of debt? Debt is going to be the same as what we have in terms of the data here. So where's the debt? That's the total long-term borrowings, right? I'm going to assume FY17 data only because we are nearly at the end of that. And market value of equity, we need to find out the market capitalization of Ultratech. If we do a simple Google search on Ultratech cement market capitalization, we get the number as 1.09 trillion. That's 1,09,000 crore. So this is 1,09,000 crore. That's the market cap. So minuscule debt in the overall equation of things. Remember, we take market values. So value of equity is this divided by this plus the debt, and 1 minus this. In fact, debt values, I think we should take both the long-term and short-term debt. So we should take this plus the borrowings, short-term borrowings as well, right? And that might change the numbers a mild bit, but nothing more than that. What is the cost of capital then? 0.93 into 11.4 plus 0.07 into 8% into 1 minus the tax rate, which is here. And so that's my weighted average cost of capital. It's about 11%, and that's because we have assumed a beta of 0.8. We are yet to do the beta calculation. Once we do this, we will embark upon our calculations for this year. We'll embark upon trying to find out what's the correct set of assumptions that we should put in so that we can close this model down to arrive at what should be a correct equity value of the company, right? We will also have to assume a terminal growth rate. And once we make that set of assumptions, then we should be able to close down this model. Once we finish the model for the standalone company, that's when we will try and add the value of what's going to happen once the capex hits, once the new capacity that they are getting on account of acquisition that hits in. And we will also be able to therefore incorporate a sense on whether at the price point that we are paying, is it value accretive or not, right? So we'll see how that goes as we kind of put in the numbers. So far, we have not debated any of the numbers. It seems profit is going down, which doesn't make sense with respect to the fact that utilization should be going up, right? So for all practical purposes, I think we are a little bit bearish on this point of time around the company. We will need to check our assumptions carefully, something we'll do in the next set of videos. Thank you.